Bienvenue à cet événement qui est co-organisé par la chaire de fiscalité et le département d'économie. On est très content d'avoir Michael Smart ici qui va nous parler de l'impôt et la demande pour la redistribution au Canada. Et tu as 45 minutes et puis on va avoir des questions.
45, on m'a dit 1 heure. Est-ce qu'on peut négocier maintenant ou non?
C'est une question si on veut les questions à la fin ou si on veut les questions au milieu. Donc,
le fin sera à quelle heure exactement?
À 13h.
13h, ok. Très bien. Alors,
on va garder des grandes questions pour la fin et juste des questions de clarification peut-être pour l'exposition. On est très content de parler aussi, d'écouter des questions en français. Et avec ça, je vous laisse en fait la scène.
Merci. Et merci à tout le monde d'être ici. Je suis très heureux d'être ici et vous parler de l'impôt et de la demande pour la redistribution au Canada. Je vais vous parler en anglais. Je veux dire que j'habite Montréal cette année. C'est une sabbatique pour moi ici et j'aimerais bien apprendre le français, mais je trouve que les mots techniques sont trop difficiles pour moi. Ça ne vaut pas la peine que vous m'écoutiez en français pour ça. Mais je veux évidemment commencer en français pour dire que c'est important de moi de parler français au Québec et même si vous voulez me poser des questions en français, c'est possible que je vais vous comprendre. On ne sait pas encore, mais on peut essayer si vous voulez. Mais je vais vous parler en anglais, mais j'ai essayé aussi à traduire mes diapos, c'est ça, mes slides en français et j'espère que ça va marcher pour tout le monde. Okay, so we're going to switch to English. We are going to talk about taxation, income taxation, the demand for redistribution. The paper is with Sylvia Joffrey, a PhD student in Toronto, and Kevin Milligan, who I imagine some of you know and may have been here before. Okay, so what do I mean by redistribution, and how is it I'm going to tell you how much Canadians want in redistribution? Well, the starting point is to recognize that when we think about the array of all policies available to governments in Canada or in any country around the world that touch on inequality, we may think in the first case about income taxes and other forms of taxation as a way of redistributing from rich to poor, but it's not the only means the government has available for addressing inequality. Many other government programs, particularly spending programs, regulatory programs of various kinds, have an impact on pre-tax income inequality. That is, such programs will have an impact on what people earn in their jobs and in labor markets. And these programs, by affecting let's think of just a few examples to begin. The minimum wage policy is not a tax policy, but clearly has an impact on the pre-tax distribution of income. Job training programs are another key example of a program that affects the pre-tax distribution of income. And I'll talk about regulatory policy afterwards. We can think of many ways in which a government influences not what you earn, what you pay in taxes, and therefore what you earn after taxes, but they're influencing what you earn before taxes as well. And we call such programs, we now call them more often pre-distribution rather than redistribution. And so this is an important element of what government does, in my opinion, that should be encouraged. But in thinking about how to evaluate pre-distributive programs, such as, say, a job training program, we are faced with a problem in evaluation. We're faced with a problem that we must know how much the government values redistribution before we can say whether these programs are effective or not. And so that's what we want to do. We want to evaluate pre-distribution programs and compare them to redistribution through the income tax system. To do that, we need to know the preferences of our society and of our government for redistribution. And what that's going to mean, in essence, what are the preferences? How will I represent those preferences? I want to know what we call in public economics the marginal social value of $1 in income for each person in society of their respective individual incomes. I'd like to place a value from a social perspective on giving $1 in after-tax income or consumption to a rich individual or rich family versus a middle income or low income family. So if I knew what all those marginal social valuations were, I would be able to evaluate all the government policies that involve government spending, which touch on the pre-tax distribution of income. And so it's just some key examples of the kind of cost-benefit analysis I would like to do. I've been told to stand right here. I want to stand here, but that won't, Antoine, that's not going to work, right? I have to. Okay. C'est bon pour tout le monde, même les gens en Suisse. Okay. Okay. So one example is, suppose the government is going to spend $100 million on a program, and that program is estimated to increase incomes in the bottom quintile of our income distribution, but only by an aggregate of $80 million. Is that a good program? Is it worth spending $100 million to increase incomes by 80 million at the bottom? Right? So why, you can imagine why that's going to be the case in specific cases. We're just saying any program will have some inefficiency, will have some excess costs associated with it. How much such excess cost should we tolerate? Well, in this case, obviously, if we value $1 in income in that bottom quintile by 1 over 0.8, by at least $1.25, then it would be worth it to spend 100 million to get those 80 million in benefits. If we place a lower value on that group, then the program would not be valuable. Another very different example I'll talk about in more detail is to think about a merger between two companies. Let's imagine that that merger creates some social value because it reduces costs through synergies or efficiencies in the company. So the new merged entity will have lower costs by, say, $100 million, but it'll have more market power. So consumer prices will rise by a total expenditure of $50 million. Is that program desirable? So clearly the people who own the company will benefit, the people who buy from the company will be harmed. So how do I evaluate that trade-off? Okay, so how are we going to arrive at these numbers describing our marginal social valuations? The key idea is just this. What value do we place on reducing inequality? Well, it's an opportunity cost. The way to think about the answer is having more inequality creates an opportunity cost for us. With this additional inequality, we could always change our income tax system to offset that inequality by increasing taxes on the rich, paying more benefits to the low income. Yeah, but that would have an efficiency cost. That income tax reform would have an efficiency cost. And that's the opportunity cost of inequality. If we're going to consider a program that increases inequality, we should take into account the cost to us of removing it through an income tax reform. Even if we're not going to actually change our income tax system, that's still a cost that we should account for. If we're going to look at a program that reduces inequality, the reverse is true. Well, that program reduces the opportunity cost of redistribution through the income tax. So in both cases, if we can measure the cost of redistribution through the income tax, it tells us how much we care about inequality and how much we should spend on programs that reduce inequality. Okay, so what am I going to do today in, we'll say 45 minutes, but it might be a little more. I'll explain the theory behind the statements I just made. I didn't invent this approach. We call it the inverse optimum approach. It's been explored by economists, other economists for other countries. But I'm going to produce calculations based on this model for Canada for the first time. So I'm going to calibrate the model to data on the distribution of income in Canada and on the system of taxes and fiscal benefits that we have in our system now. It will allow me to estimate the costs of redistribution through the tax system and therefore the benefits that we must be experiencing by redistributing through the tax system. So how did I do here? I've written estimates of the pondération du bien-être social. Pondération, je trouve ça bizarre que c'est le mot français, mais I want to say social welfare weights. Is that right? Yes. Pondération. Okay, so you're going to see that word a lot. I mean social welfare weights. I'm going to show you what they are for each percentile, for each 1% of the Canadian income distribution. And I'll look over time to see how this has changed over time. And then I'm going to show you how you can use these weights in a cost-benefit analysis. And the particular cost-benefit analysis application I'll show you is an example of merger policy. We'll look at a merger between two companies that creates a reduction in cost but an increase in prices, and then we'll try to answer the question, is that good for Canada or not, based on the weights that we've estimated. Okay, well, how could you do this? I mean, the basic idea of the cost of redistribution, I hope you see what I mean, but how can we actually estimate the cost of redistribution? So here's a very specific and simple example of a tax reform, which these are rough numbers in the example, but they're roughly calibrated to the true numbers for Canada. And so we to think about the choices the government is making in designing its tax system, given these kind of numbers, right? So we'll think about a reform in the tax rate being paid by taxpayers in the top tax bracket in Canada, which now in most provinces kicks in around $220,000 in individual income and higher. And so that threshold for the tax here, I'm going to call it K, and the average income of the taxpayers in that top bracket, I'm going to call that Y, and I'll say there are N taxpayers who are in that top bracket in Canada. Now, if you take the total amount of revenue that's in that top bracket, it's just Y minus K for each individual, right? That's the portion of their income that's subject to the top bracket rate, multiplied by the number of people, you get about $100 billion in income in that top bracket in Canada. And right now, we have about a 50% tax rate on that top bracket. And I'm going to make an additional assumption, which is the elasticity of taxable income is 0.2. We'll come back to that later, but of course what it means is as taxes go up, people will report less income, either because they're working less or because they're just reporting less in income. So higher tax will mean a lower reported income for those reasons. If you take those kind of three facts, now think about what would happen if the government raised the rate from 50% to 51%. Just a small increase in taxes at the top. Well, the cost to the taxpayers in that bracket is very easy to calculate. It's $100 billion in income in that bracket, 1% higher rate. They're going to pay costs equal to $1 billion additional dollars. But the benefits for the government are not going to be $1 billion for that reform. The reason is because at the higher tax rate, there will be some reduction in the incomes reported by those taxpayers. Based on this number, I would estimate the most likely impact on marginal government revenue, most likely increase in government revenue that will come about will be that $100 billion, the $1 billion direct or mechanical effect, minus the effect of reducing the size of the tax base here. And this cost will be about $400 million in loss due to behavioral responses. And so the net impact will only be $600 million. So the government has a choice. They could raise the rates. If so, it would cost the highest incomes in our society $1 billion. And it would benefit the government $600 million. Okay, so just assume those things are true, but understand also why I say they're probably true. Now think about how to evaluate that choice, right? So that's the choice the government faces. If it increases taxes, create $1 billion in cost to get $600 million in benefits to the government. If they reduce rates to 49%, the same would be true in reverse. Create $1 billion in benefits, but lose $600 million for the government, right? The government doesn't do either one of those things. They've chosen the rate and they stay at 50%. And so we can conclude the government is roughly indifferent between those two things, right? They neither prefer the 600 million more than the 1 billion in loss to that group, nor the reverse. They're happy with that. So I'm using, for any economists in the room, you know, I'm using the first order condition here. That's all I'm saying is they're right at the optimum point. These two things have the same value. But if these two things have the same value, then I know that the social value of income to the top bracket taxpayers must be equal to 60% of the value of government revenue. Okay, in the simple example, I know what the marginal social value of people in the top bracket is. It's 60% of the average, if you like, or of the value of government revenues. And I'm just going to generalize the logic of that example to calculate the same percentage relative rate for every income group in Canadian society. Okay, so what am I going to do? I spent a little bit of time on that theory, just elaborating that idea I just gave you. Then I'll show you the data and the results, and then I'll talk about this merger example. Okay, so our question is, what does observed tax rates at each income level? Marginal tax rates is what I'm going to focus on. So T prime means the marginal tax rate, the tax you pay if you earn $1 more or report $1 more. What does that tell us about the social value of $1 of income for people at that income level? I'll call that the G of Y function. Again, it will be a number like 60% for every income level. Right, that's what that says. So you see the idea of the trade-off here. At the top bracket, it's a very simple trade-off, right? It's just extra revenue versus extra cost for people in that bracket. As we go down the income distribution to lower and lower tax brackets in our system, the trade-off becomes more complicated. When I think about a middle income level, I think about increasing the tax rate there, there's a similar trade-off, but it's subtly different. If I increase the marginal tax rate at an income level Y in the middle, the impact of that is going to be to increase the percentage of income paid in tax, not really by people at that level Y, but at all higher levels of income, right? Because they're going to be paying that higher marginal tax rate on some of the earlier dollars that they earn, that lower bracket. And so there's going to be as they increase marginal tax rates at Y, there's going to be a redistribution away from people who are earning incomes higher than Y. And then the other side of the trade-off is the same. There's going to be a disincentive to work and to report incomes for the taxpayers who are paying that higher marginal tax rate. So that's the trade-off we're going to evaluate. And in doing that, we're using the principles of revealed preference. If the observed tax system is the optimal choice for us as a society, and there is this trade-off, we can infer what must be the preferences of people that cause them to choose those taxes. Okay, so just in picture is really the same idea. Now we'll look at, I'm going to tell the same story. I'm going to try to do it fast because I hope we're all on the same page. But I want to do it for a place in the middle of the income distribution and a more complicated tax system. So in my example, there'll just be two tax brackets now, a low marginal rate for low incomes, a higher marginal rate for higher incomes. But this, we can generalize this to as many tax brackets as you wish. And so what I'm showing you here is the budget constraint. That is, for any level of pre-tax income an individual reports to the government, this line tells you how much they're going to have after taxes. Right? So this is going to be their income minus the amount they pay in taxes, which is their disposable income. In this case, the marginal tax rate here is relatively low, and so this curve rises, the budget constraint rises at a high rate. Above a certain level, I'm assuming a higher marginal tax rate. Now let's think about what happens if around an income level Y that's in the lower bracket, I were to increase the marginal tax rate. So what will that do to this budget constraint? Higher marginal tax rate will mean that as incomes rise through this range, people pay more in taxes, receive less in after-tax income. But here, close to Y, that's a pretty small effect. It doesn't really affect their incomes very much. But if I do that over a range of incomes, a new tax bracket that's, say, delta dollars wide, and I increase the tax rate by, say, tau % in that range, then everyone who earns higher than Y will pay more in taxes. Right? So all of these people, even though their marginal tax rate didn't go up, their total taxes do go up, and they go up by tau % times the delta dollars that are in that lower new tax bracket. Okay, so here's the transfer. When I increase taxes here, here's the transfer away from the richer people. They pay more in taxes, and we can think about what that's worth here. Let's imagine that the government starts with a clear idea of how much they value incomes for each group in society. Let's imagine that the average value the government places on incomes of all people above Y is some level G of Y. Well, the benefit to the government then of taxing these people is 1 minus G per dollar of extra tax that they pay. So I know the benefit of this is 1 minus G bracket times tau delta times the number of taxpayers in. Now, the flip side of this is that among these taxpayers who pay higher tax rates, they're going to respond by reporting less in income. These would be the behavioral responses that we worry about in the tax system. So this is going to lead to a behavioral reaction and a reduction in revenues for the people who are in this bracket. How much lower is that going to be? Well, it's going to be just their marginal tax rate approximately times their change in income. I can express that in terms of an elasticity of taxable income, which we'll call epsilon. Okay, so this is our measure of behavioral responses. Epsilon, just the percentage change in income divided by the percentage change in 1 minus their marginal tax rate. So if I know what epsilon is, imagine the government knows what epsilon is, knows how much they value redistribution, they can figure out exactly what would be the impact on their revenues if they raise rates around income Y. And that's what it would be. Okay, so again, the principle of optimality tells us if the government has figured all this out, or has at least some guesses about these parameters, and it's made the appropriate calculation, then it must be the case that no reform from the existing tax system could increase social welfare. It must therefore be the case that the value that the government is placing on raising taxes from the richer group, that's 1 minus G per dollar per person, is equal to this expression. That's the behavioral cost of raising taxes at income level Y. And then we scale it by the number of people who are at Y compared to the number of people who are at higher income level than Y. Okay, so that's our optimality condition describing the government's choice. For any given preferences G over redistribution, it will tell the government what marginal tax rate to set at each income level. That's our optimal tax formula. But today, we're going to read it in reverse. We're going to say, given we know that the taxes, what the taxes are, given our estimates of what the behavioral responses are and the distribution of income is, we can now infer what must be the government's distributional preferences. And to do that, technically, I don't want to know just the average value placed on all people who are richer. I'd like to know the exact value at each income level Y. So instead of talking about the average value capital G, I want to know the social value of transfers just to people at Y. To do that, I combine two reforms, increasing taxes just below Y, decreasing taxes just above Y, and I arrive at this formula. So this is more technical than I want to be today. I'll just point out that this is the optimal inverse model, the inverse optimal model. If we have data on marginal tax rates, behavioral responses, and the distribution of income, this formula tells me exactly what social weights can explain the taxes that we have chosen. Any questions? I'll just pause for a second. Okay, so I'm going to get data on these things. Notice, what's this going to tell us in general? Basically, if marginal tax rates are increasing at a certain point, that's a sign that the government is placing a high value on those people relative to people who are richer. They're imposing higher taxes, but not on me, on the guy who's a little richer than me. That's a sign the government cares a lot about me. But this is also a joint condition on the distribution of incomes. Generally speaking, all else equal, for a given tax rate, the effect of the distribution of income is, right, so if somebody has a 40% tax rate and a very low income, that's typically going to mean the government values them highly. If somebody has a 40% tax rate or 50% or whatever and a high income, that's a sign the government values those people less. Okay, so we have to know both the distribution of income and the distribution of tax rates to use the approach that I use. Just one last example to explain what we're doing here. A very simple formal example here. I'm going to assume that taxes don't affect whether people participate in the labor market or not. I'm going to again assume one tax rate in the top bracket, say tau star for incomes above K. And I'm also going to make an assumption about the distribution of income that we call the Pareto law. And if I make all of those assumptions, then I know exactly what the weight is. It's just a simple function of the tax rate, the elasticity of taxable income, and the degree of inequality. And in particular, this tells me that the higher is the marginal tax rate, or the higher is the behavioral responsiveness, epsilon, the lower is the weight on the people in that group, right? So if we know that there are huge behavioral responses, so if I increase taxes, people are going to cut their incomes, but I still keep a high tax rate, that can only be explained by I really don't like those people. Not that I don't like them, of course, but I wish to redistribute away from them. So the higher epsilon or tau star, all else equal, the lower is the weight on that group. And the higher the inequality, that would mean the lower is the parameter A describing the distribution of incomes. The higher the inequality, that means that raising taxes on that group will raise even more revenue, right? If there's a lot of inequality in that top bracket, a small tax increase can raise a lot of revenue. And so more inequality, lower A will imply a low inequality, higher A will imply a lower, it's got to be the other way around. Sorry, let's try to read the French together. The social weight increases with the inequality in revenues. If there's more inequality, then raising taxes is going to create more revenue, and therefore the only way to explain the taxes that I have is that I don't increase taxes because I value those people high. Okay, just the last thing very quickly is, with this particular formal example, if I just plug in the right numbers from my example at the beginning of the paper, I'll get exactly the weight of 60% coming out of this formula. So I spent more time on the theory than maybe I should have, but I want you to see this is an abstract concept. How much do we care about people of different income levels? This comes out of the data in a pretty direct way once you know what the behavioral responses to taxes are. Okay. Yeah, I'm on track, actually. I'm going to be okay. All right, so how do we estimate this? Here's a description of my data. This is important enough to me that I saved the same slide in English. If anything is unclear, we can figure out exactly what I was trying to say. So what do we need to do this? We need the distribution of income. We need the schedule of marginal tax rates at all income levels. That's all we need. For the distribution of income, I'm going to calculate the distribution of income for census families. That's basically, that's nuclear families. That's a relatively small concept of what families are. And to do that using data from the Banque des Données Administratives Longitudinales, which I will call LAD by its English acronym. This is the 20% sample of all the tax returns in Canada that's available in a very confidential environment. It's available to researchers here in Canada. The tax specialists in the room know very well what the LAD is, of course. And in calculating the distribution of income, I'm going to talk about total income, and that's all people's market incomes, plus the transfers that they receive to the extent that they are taxable. So for example, Canada and Quebec pension plan contributions. I will count them as part of people's pre-tax income, even though it's a form of government transfer payment. Yeah. Okay, so when I talk about income, that's my concept of income. Taking the data from the LAD, I'll just calculate the average for each percentile of the income distribution for each family type and for each year in my data. In the top 1%, I won't spend much time on it today, but we're especially interested in them, so we look into smaller groups. Then to capture the distribution, we have some estimation procedures, which I won't talk about today. So that's the distribution of income. The next step is the marginal tax rates, income tax rates, which I'm going to simulate for each of the years from 1988 up until 2018. Right, so I want to know for each individual at each point in the income distribution, what's their marginal tax rate? So that's going to capture the disincentive effects of the taxes, but also when I look over the whole distribution, it'll tell me how much redistribution is happening as well. And so to simulate these, I'll use the so-called CTAX. My co-author Kevin Milligan has written a simulation program for this. Let me talk about how I'm going to do it here. In this case, I'm going to use actual data rather than, sometimes when fiscal economists do this, we talk about typical taxpayers with particular characteristics. I'm going to use people's actual behavior on average at each point in the income distribution to calculate how much tax they pay and how much marginal tax rate they would pay. I won't use the LAD data because we haven't had time to do that yet. Instead, I'm going to take a sample of 258,000 families from the Canadian Income Survey, Enquête canadienne sur le revenu, CIS in English. These people are examples of actual taxpayers making actual choices which influence their marginal tax rates. So I'm going to calculate their marginal tax rates based on their actual behavior. I only observed those people over the last 10 years, roughly speaking, but I want to simulate the taxes that occur in the earlier years. So the way I'm going to do that is I'm going to take somebody, say, from 2018. I'm going to pretend that they were doing the same things in 1988, simulate their taxes, simulate how much their taxes would rise if they earn $1 more in income in that year in 1988. So that gives me their simulated marginal tax rate for, say, 1988. And then I'm going to assign that family to the percentile of revenue that they would have occupied in 1988 if their income in 1988 had been what it actually was in 2018. This is a bit complicated, right? But so what we're saying is, say somebody with an income of $70,000 in 2018, put them right around the middle of the distribution. I can calculate their marginal tax rate under the old tax rules. Then I go back and I say, well, that $70,000 would have put you somewhere around not the 50th percentile, but around the 80th percentile back in the 1980s. So I'll assign them into that earlier cell based on the old tax rules and their current behavior. Okay. And then I'll just take the average of the marginal tax rates. In a family with two adults, I'll take the income weighted average of the marginal tax rates of the two spouses. So I have one marginal tax rate per family. And then for elasticities, I'll look at different values for this ETI. That's the important thing. Okay, so what do the data look like? I'll just focus on the marginal tax rate data that we simulate based on the data that we have on people's actual behavior. And so this is for all of Canada. We'll talk about three different kinds because our tax system does depend on family structure in very important ways. So we'll talk about three different kinds of families. 2 adult families without children, families with either 2 or 1 adult, and children present, children under 18 present, and then single individuals. Okay, so these are my 3 family types. And this is for all of Canada in 2018. I'll simulate the marginal tax rate for all the families in the way I described, and then assign them to their percentiles of the family income distribution. So this schedule and the extent to which it's increasing across the graph is an indication of the progressivity in the tax system for that family type, right? So higher marginal tax rates is, as you go up, is an indication of a more progressive tax system. So what do we see in looking at this? We see some degree of progressivity, particularly for the families without children. We do see marginal rates increasing from around the 50th percentile up to the 99th percentile. These are essentially the taxpayers in Canada who do pay positive income taxes. Yeah? Whereas these taxpayers typically pay no income tax on a net basis. But these taxpayers do receive means tested family benefits of various kinds. So even though their net taxes paid could be a negative number, they could receive money back when they file their taxes. If their income were to rise by $1, their benefits would be reduced because they're means tested benefits. And that's exactly the same as a positive marginal tax rate. So we do see positive marginal tax rates over this range of individuals who are actually not net taxpayers to the government. And this is particularly true, of course, for the families with children because they receive higher means tested benefits. And you actually see that for those families, the highest marginal tax rates are not at the top of the distribution, they're at the middle of the distribution, around the 40th percentile in this case. You also see relatively low marginal tax rates at the bottom 10% or so, and then they rise quite dramatically. We are incorporating the effects of earnings on aide sociale. We tend to say welfare or social assistance in English Canada. So we're incorporating those effects as these people earn roughly above the 8th percentile in the overall income distribution. Their aide sociale is reduced. That's reflected in these high rates here as well. So it's worth reflecting a bit more on this. I mean, there are many experts on this subject in the room. You know all of this, but for many Canadians, it's surprising. Oh, wait, we have a redistributive tax system, but you're saying the marginal tax rate is roughly constant from the 50th percentile up. In fact, the highest marginal tax rates for families with children are around the 40th percentile. Surprising idea. So how could that be the case? How could they be so high for people with low incomes? I think it's useful to look at a single province and decompose those marginal tax rates. So here's first a comparison between the Canadian averages we've been looking at so far in the individual provinces of Quebec and Ontario in our data. And so let's see, Quebec is the light blue line, Ontario is the red line. I didn't choose those colors. Stata somehow knew what colors to choose. And you see Ontario and Canada are almost exactly the same. 2 reasons. This is a weighted average, and so Ontario is a huge part of the Canadian average. But also Ontario is in between Alberta and Quebec, not just geographically, but politically, right? And so Ontario really is sort of halfway between what Quebec is doing and what Alberta is doing. Okay, so Canada, Ontario doesn't matter, but the comparison to Quebec is I think, kind of interesting. Marginal tax rates throughout most of the distribution for families with children in 2018, significantly higher, 2, 3, 4 percentage points higher in marginal tax in Quebec through that range. Now, well, let's focus on just for a second. So here's just the same line for Quebec, the overall marginal tax rate. Where does this come from? This is a decomposition into the 3 major things that make it up. The red portion is income plus payroll taxes. Okay, and you see that, in fact, marginal tax rates are 0 or negative up to about the 20th percent of the distribution. These people aren't paying income taxes. They're not paying a lot of payroll taxes, and they may receive in-work benefits that we call the Canada Workers Benefit. You probably have a similar name. for it. And so that can lead to even negative marginal income tax rates over that range. But meanwhile, at the same time, these people, many of them are eligible for social assistance, and social assistance is very sharply means tested. It's still the case in many provinces. Above a very small disregard level, every dollar you earn reduces your benefit by $1. Marginal tax rates in social assistance in many provinces are still, for the able population, as high as 100%. Non-disabled is the term I should use. Okay, so these tiny incentives to work more in the income tax system just offset a portion of the disincentive that's in the provincial social assistance system. The third element here is the refundable tax credits. This is the Canada Child Benefit, the GST credit, the other means-tested benefit programs that are run through our tax system. You can see that for families with children, around the 30th percentile, start to increase the marginal tax rate. That is because your benefit is being reduced as your family's income rises. You see it's very sharp in 2018. This is after CCB expansion of 2015. And that is really what leads to the peak in the marginal tax rates around the 40th percentile. This would be an income of around, what is it? Around $50,000, I think, where these things peak. Okay, so that's how we get this pattern. Back to what it means in terms of our willingness to redistribute across groups. But here are my estimates of the social weights that come out of this. And so the fact that we're putting these high marginal tax rates in the middle instead of at the top, it doesn't mean that we love the rich and we hate the middle class. It's not an indication of that. It's a sign that we're trying to target our redistribution below the 40th percentile of the distribution. And so that can in fact be an indication that we care very much about, just below the 40th percent. And that's kind of what emerges here. These are the weights. This is the value of $1 in after-tax income received by each group in society relative to $1 government revenue. So this says paying $100 to people in the bottom of distribution if they have kids is the same to us as having $152 in revenue. Right? We're willing to pay $152 to increase the income of these people by $100 at the bottom of the distribution. The top of the distribution, the top 1%, the equivalent weight is 29%. We only value $100 in income there, the same as $29 in government revenue. So that's the sense of our desire to redistribute. Now, these things are not decreasing steadily in incomes. You can see that for childless couples, they actually peak around the 10th to 20th percentile. You can see that for single individuals, it does decrease steadily. And families with children kind of in between, right? So what's going on with that? This is all about the means-tested benefits. We're essentially saying to these people, we want you to work. You're not getting a lot of benefits from the government, and we created additional incentives that mean that the rewards to earning above the 20th percentile are relatively strong for this group. Right? They don't face a lot of clawbacks of their benefits. The result of that is that we have this steady reduction. For these other groups, it's a slightly more complex pattern, and indeed, for the families with children, the weights virtually peak around the middle of the distribution, as I said. Just talk a little bit about how these things have changed over time and what we can learn from that. If I look between 1988 and 2018, I see that for most taxpayers, as for most people who do pay net taxes, top half of the distribution, marginal tax rates have fallen over time. And so here is 1988, 1998, 2008, and then 2018. You can see that initially marginal tax rates were increasing. This was during the 1990s. As a result of fiscal pressures on the government, many additional taxes were imposed on the top half of the distribution in Canada. Then the fiscal dividend meant those surtaxes were abolished after around 2000, and you can see the marginal tax rates fall, that part of the distribution. It's only since around 2010, marginal tax rates have started rising on the top 1% in Canada, leading to these higher marginal tax rates at the top. We can look at the provincial level for this as well. You see similar patterns in Quebec and Ontario, but you do see some differences, right? So there's been essentially no change in marginal tax rates since 2008 for Ontarians between the 50th and the 90th percentile. Whereas in Quebec, marginal tax rates have increased for more of that group. You do see a larger increase in the top 1%. That's because of the combination of the federal increases of 2016 plus Ontario around 2012 catching up to Quebec and imposing the same marginal rates at the top as Quebec had already done. So we see, if you like, a more redistributive change for Ontario than for Quebec. Now, I'm not saying that these differences reflect different social preferences of the Quebecois and the Ontarians. It's much more complicated than that. There's shared fiscal incentives through equalization, through federal programs, and so on. But it's interesting to compare across the provinces. So what does this changing pattern in marginal tax rates and redistribution of the tax system over time tell us about our changing preferences, and in particular the changing preferences of the people that we elect to choose our tax system for us? Right? Well, the basic story is that marginal tax rates have been falling for the top half of the distribution outside the top 1 or 5% of the population. And that's reflected in these estimated social weights over the distribution over time. The weight, even as our tax system has become more progressive for many of us because the top rates are increasing in Canada, the weight on everybody between the 50th percent and the 98th percent is actually increasing. We're actually not increasing taxes on the upper middle classes in Canada. We're just increasing taxes on the top 1%. And so that gives rise to this very different pattern where for the top 1%, that's this group here, we actually see the implied weight falling in the last 10 years. Just another way to look at the same picture, what I'm saying is for the top quartile, these are people with incomes family incomes between 120,000 and 250,000, I think in 2018, something on that order. The weight's actually been increasing steadily over time. We're designing a tax system that's more and more advantageous to the upper middle class, but it is less advantageous to the truly rich, to the top 1%. Weight has been falling in our system since 2008. And so this tells you a little bit about social preferences of governments. This period, 2008, where there's really kind of this fundamental change, that was near the end of the Harper Conservative government federally. And these are the periods most associated with the Trudeau Liberal government. So I think we can make some inferences about political parties based on this, but of course it's much more complex. It's not just those individual parties, it involves provincial changes as well, many other factors, including changes in distribution and income. That being said, what would I conclude about political parties here? Remarkable stability. Very little changes in our tax system, even as our governments change in rather dramatic ways. And the one exception really is the Trudeau government's implementation of the middle class tax cut plus the enhanced child benefits, giving rise to this greater weight on the upper middle classes and lower weight on the truly rich. All right, what do you guys think? I'm at 45 minutes. 7 minutes? Anybody? Can I talk for another 7 minutes? OK. À quelle heure?
15 minutes, jusqu'à moins quart. C'est bon.
15 minutes, mais... Alors, il nous reste une demi-heure. Mais je veux que vous parlez aussi. C'est très important, vraiment. Alors, il faut que j'arrête sometime. OK. Enough with this. I'll just say there is some sensitivity. My elasticity assumptions are important. They're particularly important at the top. I'm making a particular assumption about behavioral responses, this is what I've estimated for Canada. It's the right value for the elasticity of taxable income. But this is a reasonable range that others have estimated that sounds quite plausible. If you increase those behavioral responses from 0.35 up to 0.5, about a 50% increase, the implied weight at the top goes way down, goes from about 40% in the top 1%, according to my preferred estimate, down to 20%, I think it is. So, why is that again? It's because if the rich are really good at avoiding taxes, then having high taxes on them can only be explained by us really not liking the rich or not liking them having income, right? So the higher you think the ETI is, the lower you must think that is government's preference for redistribution away from to those people. This is kind of a middling value, and it tells me we have a kind of a middling value, right? 40% is obviously way less. $1 to those people is worth way less than to the average person, according to my estimates. But that's not very low, right? To say that somebody in the top 1%, average income $400,000 on a family basis or more, to say that we behave as though $1 extra dollar received by them is the same as 40 cents extra received by the average Canadian of much lower means, that's not a huge difference, really, right? I mean, reality is that the average income in this group is 10 times as high as the average in Canadian society. I would expect this number to be more like 0.1, not 0.4, if we were as redistributive as I think we typically think of ourselves as being. So I think that one kind of surprising thing about this is we care about redistribution, but maybe not as much as we think we do. Was there a question?
So you're assuming that the elasticity is constant throughout the income. What about relaxing that? Could explain partly what you just said?
So yes, that's absolutely right. I'm assuming one elasticity across the distribution, except that I am assuming that here policies are also influenced by trying to get people to participate in the labor market. So it actually leads to a higher elasticity at the bottom. But Antoine may be thinking it's the top 1% and they're fiscalistes who lead to a high ETI. And the next, no offense to any fiscalistes listening, is a very important job. But it may be associated with sophistication by the tax system, the ability to exploit rules within the tax system, leading to a higher behavioral response to tax increases. So Antoine may be thinking that we should have a lower elasticity over this range. And I always get it backwards, but so if we had a lower elasticity, it's more complicated in this complex distributional context, but a lower elasticity means a higher revenue yield from tax increases. If we're not increasing taxes, it must imply a higher weight on these people. So Antoine's intuition is correct. If I assume the lower elasticity in the middle of the distribution, I would see the weights falling more quickly than they are in this picture. But it seems about right to me. So there's the sense of the sensitivity. Okay, so this is the application that I want to talk about. Once we have these weights, what can we do with them? This is the idea that we can evaluate many other government non-tax policies using these weights to tell us about costs and benefits, the way we should perceive costs and benefits. And so my example of this will be, this is welfare economics at work. My example will be merger policy in Canada, which is undergoing a fundamental change this year, in my opinion, an important change. So what does that change? Right now, in the existing Competition Act, Section 96 embodies a particular trade-off between consumers and producers. It says that anti-competitive mergers may be blocked in Canada, as in every other country with antitrust law. They may be blocked, but the tribunal, the competition tribunal, shall not block the merger, according to Section 96, if it is likely to bring about gains in efficiency, that's reductions in costs, gains in efficiency that will be greater than and will offset the effects of any lessening of competition. So when economists read this statement, it's like, well, okay, that's like economics 100. It's a total surplus standard. Measure the cost to the consumers, measure the benefits to the owners of the company, or producers as we tend to say. If the benefits to the producers of cost reductions are larger than the losses to consumer from higher prices, then we should allow the merger to happen. Right? So it says a dollar is a dollar. A dollar of gains for producers is exactly the same as a dollar of losses for consumers. That seems to be what Section 96 says. In practice, the courts have decided that it doesn't say that we should apply this comparison of gains and losses for producers and consumers, but we should put a higher weight on consumer surplus than we do on profits or producer surplus. The Federal Court of Appeals said that in Superior Propane in 1999. Since then, there have been relatively few tests of this section in Canada, but when the Competition Tribunal has worked on these cases since Superior Propane, the tribunal has tended to take the weighted surplus approach suggested by the courts, and they've tended to think, apparently the tribunal thinks that the weights are just something that we can choose based on our own ethical judgments. That is, each of us can decide how much we care about the rich versus the poor, and that can guide our choices in this action. But that's very difficult, right? For a court to decide how much we care about rich versus poor, that's not the job, in my opinion, of judges. It's the job of legislators. So that's difficult. it's also the case that there's a lot of ambiguity about how to actually do this. What should be weighted more for consumers and less for producers? The courts don't really know the answer to that. And so that's left kind of a difficulty for the tribunal and for the government's prosecution arm, the Competition Bureau, to decide how to apply Section 96. And in my view, economists can help here, that we can calculate what the weights should be for these kind of comparisons. We should be able to determine exactly what the weight should be on consumers relative to producers in any particular action. And it's not a matter of individual subjective judgments. It comes from the tax system. We should expect our competition policy to be exactly as redistributive as our income tax policy is, right? We never want a competition policy to be more redistributive than our income tax policy is. That wouldn't make any sense. If we want more redistribution, let's not do it through competition policy. Let's do it through the income tax system. And so the weights that we get from the income tax system tell us what weights we should use in evaluating these trade-offs. Okay, and then, why do I care about this law now? This defense was invoked in the recent merger, which you may not think about much here, except for Videotron was involved as well. But that was a big case, and Rogers and Shaw said that the efficiencies would outweigh the cost to consumers. That made the Competition Bureau extremely unhappy, I can tell you. And perhaps as a consequence of that, but other factors as well, the government's tabled amendments to the Competition Act this fall, which will abolish this defense altogether. Right, so it would take out any concern about efficiencies from the Competition Act whatsoever. So they're kind of, in my opinion, we might ask, is this throwing out the baby with the bathwater? Could be hard to do this, but should we not even try? Okay, so I'll just show you a few pictures from Economics 100 to indicate what I'm doing here. So you know the basic story, here's a demand curve, here's a price. If that price is higher than the cost, the marginal cost, then we know there's an inefficiency here. But we also know that there's some benefit to the consumers, which can be measured by their consumer surplus, what they'd be willing to pay minus what they actually do pay. And there's some benefit to the producers, right? Which here I call producer surplus. For the units that they sell, the difference between the price and the cost. Well, you can just think of that as profit. It's just monopoly profit. Okay. What happens if we have a merger that increases prices while reducing costs due to efficiencies? Well, three things will happen. Obviously, P goes up, C goes down. But if P goes up, the demand will go as well, right? And so there's an actual loss of production. And this is the efficiency loss that we have to focus on here. And just one more picture from Economics 100, right? So here are the three areas to think about here. Higher price means a lower quantity. There's some value to those units which is lost. We call this the deadweight loss of the higher price, right? There is a gain. The lower cost means higher profits or producer surplus. And then the third term here, it's a higher cost to the consumers. It's exactly offset against higher revenues to the firm, right? And so if we do Section 96 as I read it, as most economists would read it, we're just adding up the change in consumer surplus, the change in producer surplus. Consumers lose that transfer amount, the pink amount. Producers gain it. It's a wash. When we add this up, we say, well, that's irrelevant, right? It doesn't matter whether consumers are paying more because it's exactly offset against the extra profits of the producers. So the total surplus approach that 96 was written with is got to be wrong. That's not what competition policy is about. We should put some weight on this transfer. We should say it's bad to transfer from consumers to producers. That's the point of Competition Act, competition law. But we shouldn't say that the change in cost is totally irrelevant, right? So we need something in between total surplus and a pure consumer standard here. And that, to me, is weighted surplus. So let's put a weight on the benefits to producers of the higher profits versus the loss to consumer of the higher prices. And so that's what I'm going to do very quickly. I'll just say I'm going to take data on who buys wireless products of Rogers and Shaw and who owns the shares in Rogers Shaw. And I'll use that to figure, and I'll use the weights that we have calculated, the G's that we've calculated in the first half of this paper, and figure out, well, how important should consumer surplus changes be in the wireless market compared to profit changes? And that's going to give rise to the scale factor, the amount by which we would scale consumer surplus in comparing it to producer surplus. It's not one-to-one. We're going to put a higher weight on consumers than producers, but we're not going to put infinite weight on consumers here. And so I'm going to go faster than maybe I want to shut up, and so I'm going to go too fast. Here's my data. Just tells you for each 10% of the population, how much of total spending on cell phones do they do, and what portion of shares do they own. For the portions of shares, notice it's mostly the top 1% who own shares in Rogers and Shaw, or foreigners. Foreigners get no weight in our welfare function, but all of these people, their extra incomes from their shares in Rogers Shaw will be subject to corporate and personal taxes, including the foreigners who will pay some residual taxes at the corporate level. And so I'm going to count the effects of the corporate taxes generated by the higher profits of the merged entity as well, and I'm going to weight it in the same way. Okay, so what do we get? Depends on the elasticity we use. This is my preferred epsilon equals 0.35. This shows you the value to place on consumer surplus profits and income taxes relative to the value of $1 in the top 1%. It's a pure normalization. It says that every dollar of lost consumer surplus should be valued at $2.18. Every dollar of lost profits should be valued at 82 cents. Why is this so low? Because a lot of the owners are foreigners who should not count at all. Their profits don't count at all. But then there's a bunch of income taxes too. Every dollar is going to generate equivalent 77 cents in income tax relative to the value of the top 1%. So when I add all of that up, the total value of profits is $1.59. The ratio of these two things, the value on consumers relative to the value on profits, is 1.37. And so the conclusion is that under this weighted surplus rule, this transaction is desirable if the gains to producers, the efficiencies, are at least 37% larger than the losses to consumers. So if we were to estimate consumers are losing $100 million, we need to see at least $137 million in efficiencies, in cost reductions, before it would be desirable. 37%, that's a pretty low hurdle, right? So a lot of things are going to pass that test, right? So why is it a relatively low hurdle? We put a pretty high weight on people in the top 1% in our tax system. Also, we're getting all the income taxes that would be generated by these higher profits. That's not a bad deal overall. And so the result is efficiency matters a lot. And this conclusion is pretty insensitive to the elasticity that I use, plus or minus 15%, roughly speaking. Now I'm going to stop there. I'll just say a couple of words about a couple of final remarks. What do I think we're doing here? It's a way of quantifying the efficiency costs of the tax system, and then making an inference about social preferences for redistribution. Those social weights then can be used for many other purposes. They're informative about how we should design non-tax policies as well. There has to be one big finish, but I don't think there really is, as I read through the French words on this slide. Maybe it's this. The estimated social value of income in the top 1% is about 40% of the value of government revenues. We do care about redistribution in Canada, but maybe less than you would have thought we did, given the tax system we have in place. And I think that simple fact, if you agree with it, tells you a lot about how other policies should be designed in Canada. Thank you very much.
Merci pour cette belle présentation.
Merci.
Donc, on va peut-être d'abord prendre les questions de la salle, et puis les questions. Il y en a pas encore. Ok. Est-ce qu'il y a des questions? Peut-être prendre deux ou trois.
I will try in English. Actually, in your model, you have the different kinds of households. One is without or with children, and single. Not only Antoine has said that your epsilon should be different for different kind of different level of incomes, but maybe different families can have very different epsilons too, because a single mom cannot drop their job, because that's her only revenue. So there's something maybe, especially now the social tendencies that the single parents households are increasing, and this might give you this jump of the the jump of the tax level, I don't know, unbelievably very high, between the 50 and 70% percentile of income, especially for the household with two adults. But in the reality, the two adults can cope together to make sure that their income to be maybe lower than that. So the jump that you have here, maybe some kind of methodological assumptions that you put there.
So I agree with you that we should consider different elasticities for different taxpayers and different incomes. I might not agree with you that the elasticity should be lower for single parents. Some evidence that single parents responses are quite large, and their incentives to participate are quite dependent on taxes. The same goes, as you suggested, for secondary earners in families with children. We think that they may be among the most, both of those groups may be among the most responsive to tax policies among people in the middle of the distribution. So a typical elasticity for secondary earners of participation, or indeed of just income earning, is very similar to what I talked about, between 0.4 and 0.8. So what does that say? 10% increase in your after-tax wage for working a job would cause people to increase their work by 4, 5, 6, 7%. So that's quite a large response relative to people without children, relative, I think, to primary earners still in such families. And when we average across families, I think that is one reason why, notwithstanding, pace what Antoine said about people in the middle of the distribution are not sophisticated about responding to taxes, but I think their participation incentives are much stronger for the reasons we've just talked about. So to me, relatively constant elasticity on the order of what I've assumed does seem quite reasonable across the distribution. If you were to change it, the second part of the answer is, if you were to change it, my answers don't change very much except at the very top. They're relatively insensitive. So this conclusion that the weight on people, say at 25% up the distribution, should be around 1.3, 1.4. If I were to change the elasticities, that doesn't change. So I think I stand by the conclusion that we care about redistribution, just maybe not as much as we think we do.
I was wondering, you're inferring government social weights from the structure of the income tax and transfer system, but I mean, technically, most likely government is considering the whole tax system as when it's thinking about redistribution. So it's not only the income tax system. You could want to think about consumption taxes and perhaps business income taxes as well. Would that, well, I mean, it's a different ballgame. It's not the same data, but what would you expect that to do to the results if we included the full tax system?
That's a great point. We do redistribute through a lot of means. Now, I have included social assistance here, which is not a tax program, but it's in what I've done. Consumption taxes aren't there. If it were the case that, of course, we all pay the same rate of GST or QST, but some things are taxed through that system and some are not. And so there can be some implicit redistribution. In particular, we exempt or we zero rate under QST and GST basic food products. So if basic food products were a higher percentage of expenditures for low-income families than high-income families, and that is true, then the effective sales tax rate would also be progressive, would be increasing as incomes rise. If I were to add that, there'd be more progressivity, and therefore more of a sense of a preference for redistribution. Now, I haven't done these calculations, but I think these effects are in fact very small. The effective sales tax rate is roughly the same for Canadians across the income distribution. The exemptions that we have, such as for basic foodstuffs, they apply to a relatively small portion of what we buy. So the result is we would basically add something like here in Quebec, you'd add about 5% marginal tax rate across the whole distribution to account for QST. It wouldn't change these results, hardly at all. You talked about one other interesting thing. Oh, yeah, so business taxes. One thing here is I'm taking the definition of income as being the right definition of economic and only talking about the statutory tax rate principles. But in fact, the tax base that we choose is a function of some important choices as well. In particular, We only tax 50% of capital gains, as people here know. And we have a system of dividend tax credits in Canada that reduces the personal tax rates on dividends. And those measures, though they're available to all Canadians, are only taken up by people in the very top of the distribution, the top 10%. Now, the question is, what do you think about that? Are we reducing taxes on capital as a hidden way to redistribute to high-income people? Or do you think there's some broader benefit of encouraging investment? And so depending on what you think about that choice will influence your impression of how much redistribution or a regressive effect there is through that system. Turns out that if I take extreme assumptions about who gets the benefits of those tax reductions on capital, that can increase or decrease the weight on the top 1% by about 10 percentage points. So instead of 0.4, I might say, if I had an extreme view of why we do that, I might say the weight on the top 1% is actually 0.5. So that would be the effect of these kind of business tax changes. I've noticed that next week you're going to hear about distributional national accounts. That's this seminar, right? 2 weeks from now. That will be the question we'll be talking about next week. What does it mean? How do we attribute the taxes on capital on corporations to individuals? It's our hard question. Everybody online?
Non. Peut-être moi. Si on va à la diapo 20, si on revient à la diapo 20, je ne sais pas si c'est... Sorry, 21. Maybe 19. Ah, oui, ici.
Au fil du temps.
Oui.
OK.
Si de 2008 à 2018, pour les 1% les plus riches, ça diminue, est-ce qu'on peut, comment on peut interpréter ça, l'interrelation de ça avec ce que Dalby calcule comme le coût marginal d'augmenter les fonds publics?
The marginal cost of public funds?
Ouais.
C'est une bonne question, il faut y réfléchir un peu. So there's a long tradition in public finance of estimating these efficiency costs of taxation. In the older school, there was one number to answer that question, right? There was, in simple textbook models, there was only one tax that everybody paid, and sometimes in these models, everybody was identical as well. And that allowed us to estimate a single number representing the marginal cost of public funds. And what that means in effect is to get $1 in government revenues, how much extra costs do we have to impose on the taxpayers? The typical answer to that, and I'm not sure Bev Dalby is the world expert on this, I'm not sure what he estimates, but I think he would estimate a number around 1.4. To get $1 in government revenues, the extra costs imposed on people add up to at least, the total cost will be at least at 1.4, and for some tax bases it will be 2 or 3, some very inefficient taxes. So you can tell that logic behind the Dalby approach to MCPF is very similar to what I talked about here. But I'm going to do it separately at each point in the income distribution, and I'm going to recognize that the costs that I'm willing to incur at one point in the distribution to raise revenue from those people, it has a purpose, and that is because I'm trying to redistribute from rich to poor. And so in this model, in the model that I have advanced, I can tell you what the marginal cost of public funds is on average for all of society. It is the average of these weights, right? So these are the marginal social welfare weights for each of the income groups. The average is reported in the bottom column, it's 1.14. And so that's what emerges from my analysis as the average of these weights. But the marginal cost of public funds is much higher than that at the top because there are much higher negative behavioral responses. That's not a bad thing. That's exactly why we're doing it, because we want to redistribute away from these people. So it's a slightly different perspective on what it means to have these behavioral responses. On average, the number is 1.14. If you're familiar with these models, as vous savez que Luc connaît les modèles très bien, you may wonder, well, how did you get that number? That's the participation effects. That's the overall income effects here in the system. If I assume no income effects, this would be exactly 1. The marginal cost would average 1, except for the income effects on like enforced participation. Helpful?
On va prendre une dernière question et puis les mots de clôture.
Would there be any relevance to add sort of a weighting to your weighting when you calculate for your competition laws? The top of the distribution has most of the shares in Rogers Shaw, and so they reap both the benefits of the cost reduction and the benefits of, and have less of the negative effects of the merger. So would it be relevant to cut those off of your calculation for the weighting to use in the competition?
So I'm curious about why you say the rich bear less of the costs of the higher prices through the merger. In fact, the people in the top 9%, I'm just trying to read, people in the top 9% of the distribution actually account for 16% of all cell phone expenditures in Canada, according to the survey data. That's not surprising, right? I mean, clearly everybody has a cell phone now, even the bottom 10% has a cell phone, but people at the top spend a lot more. So people in the top 10%, I think, bear more than a proportionate share of the costs as well, but they get vastly, disproportionately more of the benefits of the profits. So, in what sense for you do you think that they're not bearing costs at the top?
Well, it's less of a big proportion of their own revenue that they spend on cell phone expenditures.
But so what you're trying to do in making that statement, and I agree, yeah, but what you're trying to do is put your own welfare weight in place, right? So you're saying, okay, so people in the top 10%, on average, they might spend, what's a reasonable number? They might spend $1,500 a year on cell phones. People at the bottom, they might only spend $500. You're saying, yes, but that $1,500 is nothing to them, and the $500 is everything to people at the bottom. That's true, but that's what my weights already do for you. So all of the adjustment comes through my calculations of our desire for redistribution. We don't impose our own ethical judgments on what those numbers mean. Instead, we say, yeah, these guys are paying more than their share of the cost of cell phones, so they're going to bear more than their share of the increase in the cost. Of course, it is more than offset by the corresponding increases in profits at the top, but they're not necessarily the same people, right? And that's, you know, another flaw in this analysis. We don't consider differences within an income group at all. This 33% share of the profits that goes to the top 1%, that's 2 families. That's like 20 people, right? They're getting all the benefit. The rest of the people in the top 1%, they're just paying, most of them are paying the cost. They weren't smart enough to buy Rogers last year. Although actually, I'm not sure. No, I don't think they're in capital gains on this yet, but you know what I'm saying. Yeah. Okay, so there's a lot of issues here. I'd say the first thing is try to reject the idea that we have to report it as a share of individual income. It's very common in applied analyses. We do this all the time. This says, no, a dollar is a dollar until we make these adjustments for how much it costs government to redistribute a dollar. And the second part is members of Rogers pretty well out of this transaction. That's all.
Merci beaucoup pour une discussion et une présentation fascinante.
Alors, merci Michael. Alors, on profite de la situation où Michael est le premier professeur invité de la chaire Jacques Parizeau des HEC. On a profité de sa présence pour le faire venir à l'Université de Sherbrooke, à Sherbrooke et non pas à Longueuil. Donc, merci pour t'être déplacé jusqu'ici. J'en profite aussi pour dire les prochaines activités de la chaire. Donc, le 12 décembre prochain, on a une activité sur les inégalités, une nouvelle méthode de calcul qui s'inspire ou qui provient du laboratoire des inégalités mondiales. Donc, les chercheurs de la chaire ont fait cette étude-là. Le Midi-conférence va se faire avec des gens du laboratoire des inégalités mondiales et on aura une brève présentation de Thomas Piketty. Donc, je vous invite à vous y inscrire. On aura aussi en décembre, il n'y a pas de Midi-conférence d'annoncer pour le moment, mais il y aura minimalement un Midi-conférence ou la publication d'une étude sur l'augmentation du pouvoir d'achat au Québec, comparaison avec les autres provinces canadiennes et comparaison avec les pays avancés. Et au début de 2024, il y aura le fameux lancement du bilan de la fiscalité 2024. Donc, on vous invite déjà à vous inscrire. C'est dans les premiers jours de l'année de 2024. Donc, au plaisir. Merci d'avoir été avec nous. Encore une fois, près de 100 inscriptions en ligne et des gens dans la salle. Donc, on vous remercie et on vous dit à bientôt.